Good morning to everyone, and thanks for joining Tecnoglass to review our Q4 and fiscal year-end 2022 earnings call. We're excited to report again record financial metrics across the board, starting from our revenues, which were up 60% roughly year over year. In this occasion, both the single-family residential and multifamily and commercial segments contributed heavily to that growth, with single family growing about 59% and commercial growing about 61%. So it's nice to see both segments clicking in all cylinders. Gross profit margin continues to be a nice story and the driver for EPS accretion. For the full year and for the quarter, it was up substantially, starting with the quarter, 930 basis points at 52.2%. And that is derived from many factors, right? We got some pricing, operating leverage, automation was a key contributor. The revenue mix, as we continue to penetrate the single-family residential side of the business where there's no installation, you get better margins. So that continues to be a nice trend to follow. And as you would expect, as gross margins go, so operating margin goes. And we ended up with a record operating margin of 36.4% for the quarter, up more than 1,100 basis points year over year. And as a result of that, adjusted EBITDA was also up significantly to a record $87.2 million for the quarter, which equates to a 41.3% EBITDA margin. And for an EPS perspective, it went up from 50 cents to $1.09 per share year over year as well. So throughout the P&L, it was a very good story during the quarter, as well as for the full year, in which we had record quarters sequentially, starting from Q1 all the way through Q4, as we just discussed. And for the full year, revenues were up 44%, with single-family residential leading the way, which was up 73% almost, which was driven by dealer expansion, geographical expansion. We'll expand more on single-family residential and market share taken. And we'll go as to the reasons why our structural advantages continues to drive the way for us to continue gaining market share. Gross profit margin almost at 49% for the year, 800 basis points higher year over year. Adjusted EBITDA got to $265 million, up 76.8%. And again, pricing, efficiencies from automation, revenue mix, and operating leverage were the main catalysts for these results and this enhanced profitability. Cash flow from operations at a record level, $142 million for the year and $70 million of free cash flow respectively, after investing heavily for the growth and for the incremental demand that we're seeing or that we saw in 2022 and that we continue to see into 2023. Backlog in relation to that demand was up 24% year over year to a record $725 million. And as we have discussed in the past, backlog is understated because it's only comprised of the commercial revenue segment, and it doesn't include necessarily a whole lot of single-family residential, which is very spot in nature and very short-lived. So it doesn't necessarily get to be fully captured into the backlog. If you look at the backlog composition, roughly 2/3 of that is multifamily. So we're not heavily exposed to office space or hotel construction. And there are different dynamics because clearly we are stronger in the Southeast, which is an area that is outperforming some other geographical spaces in the US. And that continues to drive migration into this area of the United States. Single-family residential, as we were mentioning, went up 73%. It's important to mention that within single-family residential, roughly 2/3 of that is repair and remodeling construction. So it's not necessarily driven by the same factors as new housing starts, for instance. So when we get asked about the impacts of inflation and higher mortgage rates, while there's an impact, it's not necessarily a one-to-one correlation to our single-family residential business, because if we think about it, R&R is more counter-cyclical in the sense that if you're not investing in new homes, you're going to invest in your current ones, so in renovations and whatnot. So that's important to remember. But the segment continues to perform very well. We are gaining market share, and that segment is now about 45% of total revenues, up from just 3% back when we started in 2017. Additionally, we're expanding geographically. We're opening up showrooms. We opened one in Manhattan. We opened one in Charleston, South Carolina, and we have the intention of opening 3 different showrooms this year in California, Arizona, and Nevada. So more to come on that front. Our structural advantages, we have mentioned these quarter after quarter. We feel that they are structural and they are sustainable. We clearly have an advantage on our cost structure, and as a result, we're able to price efficiently if we need to. We have a large advantage on labor costs by virtue of manufacturing in Colombia. And we're not, by virtue of being fully vertically integrated, we have not been as exposed to some of the supply chain issues that some of our peers have had. So that has played a huge part by being able to maintain lead times at pre-COVID levels, which not a whole lot of our peers can say, and continue to investing in CapEx. Being fully vertically integrated has helped us, deliver faster and be more reliable to our clients. So we continue to feel good about our strategy moving forward. From a balance sheet perspective, it continues to be in great shape. Leverage is at 0.2 times right now. So there's a lot of flexibility. We have about 270 million of excess liquidity between cash and our committed credit facility. So we have a lot of flexibility to execute going forward. Ideally, we will continue to invest in growth CapEx because that would mean that demand continues to go up. We can also continue repaying down debt and returning cash to shareholders via dividends or buybacks. So it's nice to have that flexibility to execute on our multi-year strategy going forward. Margins and cash flow have been a nice story for the last 5 years. If you look at what gross margins have done over that time period, they've gone up from 31% to almost 49% in 2022. And again, that's due to the revenue mix that we've had with residential construction going up over the years, the investments in automation, and the operating leverage that we're driving on the business. So it's been kind of a nice story to tell, obviously much more profitability in the business, and as a result, much higher EPS from those years on. Finally, our outlook for 23, despite some of the challenges from a macro perspective, inflation and interest rates, we continue to see a healthy shape of our business. We're continuing to grow our footprint geographically. Commercial construction continues to be in a good shape, given some of the dynamics from a secular and demographic perspective in the places where we are the strongest and where we're seeing a lot of migration. So the Southeast continues to do very well on that front. And from a single family residential, we're being more cautious, but again, we're more exposed to repair and remodeling rather than new housing starts. And with that, we are projecting revenues to end up in a range of 790 to 830 million for the year, which equates to about 16% at the higher end of the range, 16% growth, and 300 to 320 million in adjusted EBITDA, which equates to about 21% at the higher end of the range. With that, I leave you and hope that you join us again to discuss the results for Q1 2003 in a couple of months. Many thanks.